On the one hand, India has a very specific history of social banking, which stems from post-independence and this attempt to use the banking sector as really a way to push for development ends. And that part of social banking has seen credit and sort of the distribution of credit as one of the roles that the state plays in negotiation with the banking sector to try to direct credit into places that it doesn't otherwise go to. So for example, the poor are often seen as excluded, agricultural credit is seen as limited. So the state has in various ways and various kinds of iterations, whether through nationalization and later on liberalization, used this idea of sort of financial exclusion or credit exclusion especially as a way to implement development policy. And so when microfinance comes out in the sort of 70s out of the Grameen Bank, then it's sort of slowly incorporated into this politics of credit that the state already has that aligns with social banking. So it sees microfinance as another way to distribute credit to people who would otherwise not be included within the financial sector. So that's sort of the social banking is one history that's often not talked about when talking about microfinance in India. The other one, of course, comes from the sort of Grameen Bank model, which emerges in Bangladesh in the 70s with Muhammad Yunus and is later expanded, and globally it's taken up, and it's seen as a way for especially poor women to access credit who don't have collateral otherwise, to form groups and use social capital as a form of collateral and to be able to access credit. In India, this takes up in two different models. One is through what is known as self-help groups, which are often small groups that women form or not NGOs form for women and try to sort of build the kind of social capital and raise credit amongst those groups, and banks lend to those groups. They're often non-profit driven models. What I look at in my research is the other model, which is a commercial or for-profit sector of microfinance, which draws on the nonprofit model of the Grameen Bank, but uses a profit principle that not only is it doing good, but that companies can also do well by lending to the poor, and that they can actually have, because microfinance has very high rates of return, they can make a profit while also expanding credit to those who are otherwise excluded. And in various ways, that sort of banking policy works, the state has included the sort of for-profit sector within its sort of ambit of what is seen as good models of credit expansion. And so that's why we have a set of different histories that align, making microfinance, but commercial microfinance in particular, something that's expanded very rapidly in India. Microfinance has a very complicated sort of outcome. On the one hand, there's no sort of structural improvements to people's lives. So it's not a silver bullet that gets people out of poverty, especially for the most needy. It helps tide over certain kinds of expenses. So if you have to, fix your roof, if you have to pay for your child's education, there are various reasons that, and in my field work, people would often talk about needing this lump sum, that they needed a lump sum for various needs, and that's what microfinance did. It didn't really get people out of poverty. So I think when the question is, what is the sort of outcome of it, it doesn't sort of remove structural inequalities. It doesn't, most of the women that I worked with weren't using it for their sort of small businesses. They were using it for consumption ends. And this is not something that's sort of unique to my findings. I think this has become increasingly the results that people have found, that there's very limited opportunities for people to use the credit from microfinance to actually, really build a business. But it does, I think, to therefore say that it doesn't work is problematic because it works in other ways than what is intended. And those other ways is that it simply helps people make ends meet. So I think the answer is always complicated because we need to think of what happens if people stop getting access to the microfinance. They're simply going to turn to other forms of credit, and those can be more predatory. So I think we have to be careful about making these judgments about whether microfinance is good or bad without understanding what it's actually being used for and what the other options are for people taking these loans. So I look at financialization of poverty as a way in which different kind of financial interest. So this is coming from sort of high-level finance, right? So the things that we talk about, whether Wall Street or the city in London, in India, Mumbai, that these are kind of removed spaces from poverty, right? It's usually talked about the wealthy. But what happens is that often these firms capture wealth from the poorest. And they do so in various ways, including through microfinance. So when I look at for-profit microfinance institutions, they're actually raising capital from banks, from financial institutions. Some of them are listed on the Bombay Stock Exchange. They're raising private equity, public equity. And so they're very much integrated into these financial networks. And so when they lend to the poor, and they, make returns on interest, all of this goes back into the financial system. So when we try to understand what's going on with microfinance, it's not simply a relationship between sort of the lender, who's this local microfinance institution, and the poor borrower, but it really does draw this entire sort of financial network together. So in that way, these large financial institutions can profit off of the poverty, off of the poorest who are making repayments on microfinance loans. And at the same time, what we see is that people are using these loans for private healthcare, for private education, at least in the case of urban microfinance, which is what I look at. And often these private institutions themselves are wrapped into these new kinds of financial networks. So we see people paying into financialized, privatized education and healthcare. They're paying into financialized credit systems through microfinance. So when I'm looking at privatization, sort of financialization of poverty, what I'm saying is that the poor are really increasingly integral to the way in which capital is taken out and circulated into finance. And that is something to sort of really think about critically. So on the one hand, we have to understand that financial inclusion is an ongoing policy. So it's really started in 2005 under the previous Congress government, and to some extent it is a continuation of a policy, even though there might be differences or they might claim differences. There is, to some degree, sort of agreement between parties that financial inclusion is something that is required and necessary for India's development. So to one extent, the current government's policy is a sort of continuation and an expansion of what was happening before. So in 2014-15, when the government implemented the PMJDY, the Jan Dhan Yojana, which extended basic accounts to all Indians, the government claims that about 90% of the Indian population, or at least 90% of households, are now have access to a bank account, which is a huge increase from previously, which was about at 60% of households. And this enables the government to do various things, including sort of shift the way in which welfare payments are made. So for the various schemes that are talked about, whether it's the NREGA, the cooking gas schemes, all of these things can now be made as cash transfers directly to people's bank accounts. It's argued that this would reduce leakages, so less corruption. People will get paid directly. They'd be able to access their money in their own accounts. So there's definitely positive outcomes to having this sort of expansion of financial inclusion. The question is, what happens after that? There are quite significant limitations to these accounts. Often it means that the poor can only withdraw about 10,000 rupees per month, or are often limited to about 4 transactions, which means that they don't have the same kind of access to bank accounts that someone with a regular account would. So as more funds are transferred into these accounts, we have to think about the ways in which banks have to work to enable people to actually access these accounts. So you can have financial inclusion in name, but it's highly unequal forms of inclusion, right? And the other part that has been important to the form of financial inclusion was that it was central to demonetization, right? So you had to have this kind of financial inclusion agenda ahead of having demonetization, because without it, you couldn't make an argument that people could access money through their accounts, or that you could simply go and deposit money into your account and sort of withdraw it from there. So it was a necessary sort of precursor to having demonetization, which, as we know, has also had significant effects on the economy, principally sort of limitations and negative outcomes but at the same time, financial inclusion was sort of absolutely necessary for that to take place. So I think we need to think about what would a next government do, because I think there will be continuation from what has already existed, that whichever government comes in or remains, that there's going to be continuation of financial inclusion. The question really is, what do you do with financial inclusion once people have been included, and does that then lead to reduction of poverty?